Trading in the Zone, Part 1. I have 5 major objectives in mind in writing Trading in the Zone. To prove to the trader that more better market analysis is not the solution to his trading difficulties or lack of consistent results. To convince the trader that it's his attitude and state of mind that determines his results. To provide the trader with specific beliefs and attitudes that are necessary to build a winner's mindset, which means learning how to think in probabilities. To address the many conflicts, contradictions, and paradoxes in thinking that cause the typical trader to assume that he already does think in probabilities when he really doesn't. To take the trader through a process that integrates his thinking strategy into his mental system at a functional level. Trading in the Zone presents a serious psychological approach to becoming a consistent winner in your trading. I do not offer a trading system. I am more interested in showing you how to think in the way necessary to become a profitable trader. I assume that you already have your own system, your own edge. You must learn to trust your edge. The edge means there is a higher probability of one outcome than another. The greater your confidence, the easier it will be to execute your trades. This book is designed to give you the insight and understanding you need about yourself and the nature of trading, so that actually doing it becomes as easy, simple, and stress-free as when you're just watching the market and thinking about doing it. Technical analysis is a method that organizes this collective behavior into identifiable patterns that can give a clear indication of when there is a greater probability of one thing happening over another. In a sense, technical analysis allows you to get into the mind of the market to anticipate what's likely to happen next, based on the kind of patterns the market generated at some previous moment. As a method for projecting future price movement, technical analysis has turned out to be far superior to a purely fundamental approach. It keeps the trader focused on what the market is doing now in relation to what it has done in the past, instead of focusing on what the market should be doing based solely on what is logical and reasonable as determined by a mathematical model. On the other hand, fundamental analysis creates what I call a reality gap between what should be and what is. The reality gap makes it extremely difficult to make anything but very long-term predictions that can be difficult to exploit even if they are correct. In contrast, technical analysis not only closes this reality gap, but also makes available to the trader a virtually unlimited number of possibilities to take advantage of. The technical approach opens up many more possibilities because it identifies how the same repeatable behavior patterns occur in every time frame, moment to moment, daily, weekly, yearly, and every time span in between. In other words, technical analysis turns the market into an endless stream of opportunities to enrich oneself. If technical analysis works so well, why would more and more of the trading community shift their focus from technical analysis of the market to mental analysis of themselves, meaning their own individual trading psychology? There's a big difference between predicting that something will happen in the market and thinking about all the money you could have made, and the reality of actually getting into and out of trades. I call this difference, and others like it, a psychological gap that can make trading one of the most difficult endeavors you could choose to undertake, and certainly one of the most mysterious to master. The big question is, can trading be mastered? Is it possible to experience trading with the same ease and simplicity implied when you are only watching the market and thinking about success, as opposed to actually having to put on and take off trades? Not only is the answer an unequivocal yes, but that's also exactly what this book is designed to give you, the insight and understanding you need about yourself and about the nature of trading. So the result is that actually doing it becomes as easy, simple, and stress-free as when you are just watching the market and thinking about doing it. This may seem like a tall order, and to some of you it may even seem impossible, but it's not. There are people who have mastered the art of trading, who have closed the gap between the possibilities available and their bottom line performance. But as you might expect, these winners are relatively few in number compared with the number of traders who experience varying degrees of frustration, all the way to extreme exasperation, wondering why they can't create the consistent success they so desperately desire. In fact, the differences between these two groups of traders, the consistent winners and everyone else, are analogous to the differences between the Earth and the Moon. The The Earth and the Moon are both celestial bodies that exist in the same solar system, so they do have something in common, but they are as different in nature and characteristics as night and day. By the same token, anyone who puts on a trade can claim to be a trader, but when you compare the characteristics of the handful of consistent winners with the characteristics of most other traders, you'll find they are also as different as night and day. On any given day, week, or month, the markets make available vast amounts of money to anyone who has the capacity to put on a trade. Since the markets are in constant motion, this money is also constantly flowing, which makes the possibilities for success greatly magnified and seemingly within your grasp. I use the word seemingly to make an important distinction between the two groups of traders. For those who have learned how to be consistent or have broken through what I call the threshold of consistency, the money is not only within their grasp, they can virtually take it at will. I'm sure that some will find this statement shocking or even difficult to believe, but it's true. There are some limitations, but for the most part, money flows into the accounts of these traders with such ease and effortlessness that it literally boggles most people's minds. However, for the traders who have not evolved into this select group, the word seemingly means exactly what it implies. It seems as if the consistency or ultimate success they desire is at hand or within their grasp just before it slips away or evaporates before their eyes time and time again. The only thing about trading that is consistent with this group is emotional pain. Yes, they certainly have moments of elation, but it is not an exaggeration to say that most of the time they are in a state of fear, anger, frustration, anxiety, disappointment, betrayal, and regret. So what separates these two groups of traders? Is it intelligence? Are the consistent winners just plain smarter than everyone else? Do they work harder? Are they better analysts? Or do they have access to better trading systems? Do they possess inherent personality characteristics that make it easier for them to deal with the intense pressures of trading? All of these possibilities sound quite plausible, except when you consider that most of the trading industry's failures are also some of society's brightest and most accomplished people. The largest group of consistent losers is composed primarily of doctors, lawyers, engineers, scientists, CEOs, wealthy retirees, and entrepreneurs. Furthermore, most of the industry's best market analysts are the worst traders imaginable. Intelligence and good market analysis can certainly contribute to success, but they are not the defining factors that separate the consistent winners from everyone else. Well, if it isn't intelligence or better analysis, then what could it be? Having worked with some of the best and some of the worst traders in the business, and having helped some of the worst become some of the best, I can state without a doubt that there are specific reasons why the best traders consistently outperform everyone else. If I had to distill all of these reasons down to one, I would simply say that the best traders think differently from the rest. I know that doesn't sound very profound, but it does have profound implications if you consider what it means to think differently. The defining characteristic that separates the consistent winners from everyone else is this: the winners have attained a mindset, a unique set of attitudes that allows them to remain disciplined, focused, and above all, confident in spite of the adverse conditions. As a result, they are no longer susceptible to the common fears and trading errors that plague everyone else. Everyone who trades ends up learning something about the markets. Very few people who trade ever learn the attitudes that are absolutely essential to becoming a consistent winner. Just as people can learn to perfect the proper technique for swinging a golf club or tennis racket, their consistency, or lack of it, will without a doubt come from their attitude. Traders who make it beyond the threshold of consistency usually experience a great deal of pain, both emotional and financial, before they acquire the attitude that allows them to function effectively in the market environment. The rare exceptions are usually those who were born into successful trading families, or who started their trading careers under the guidance of someone who understood the true nature of trading and, just as important, knew how to teach it. Why are emotional pain and financial disaster common among traders? The simple answer is that most of us weren't fortunate enough to start our trading careers with the proper guidance. However, the reasons go much deeper than this. I've spent the last 17 years dissecting the psychological dynamics behind trading so that I could develop effective methods for teaching the principles of success. What I've discovered is that trading is chock full of paradoxes and contradictions in thinking that make it extremely difficult to learn how to be successful. In fact, if I had to choose one word that encapsulates the nature of trading, it would be paradox. According to the dictionary, a paradox is something that seems to have contradictory qualities, or that is contrary to common belief, or what generally makes sense to people. Financial and emotional disaster are common among traders because many of the perspectives, attitudes, and principles that would otherwise make perfect sense and work quite well in our daily lives have the opposite effect in the trading environment. They just don't work. Not knowing this, most traders start their careers with a fundamental lack of understanding of what it means to be a trader, the skills that are involved, and the depth to which those skills need to be developed. There is a common assumption that traders are risk takers. Of course, any trader is taking a risk when you put on a trade, but that doesn't mean that you are correspondingly accepting that risk. In other words, all trades are risky because the outcomes are probable, not guaranteed. But do most traders really believe they are taking a risk when they put on a trade? Have they really accepted that the trade has a non-guaranteed probable outcome? Furthermore, have they fully accepted the possible consequences? The answer is unequivocally no. Most traders have absolutely no concept of what it means to be a risk taker in the way a successful trader thinks about risk. The best traders not only take the risk, they have also learned to accept and embrace that risk. There is a huge psychological gap between assuming you are a risk taker because you put on trades and fully accepting the risks inherent in each trade.